Hey, Talk Tickers listeners, welcome back. Today, we're diving into TLYS' latest earnings call, ticker symbol TLYS. And let me tell you, this teen retailer had quite a quarter. We're talking about a potential comeback story in the making. So we're going to break down their transcripts, some analyst opinions, and even a few market rumors to figure out if there's a real opportunity here.
What's interesting is that TLYS seems to be walking a tightrope. They're targeting Gen Z, who, let's face it, can be a tough crowd to please. But they're showing some promising signs of life after a pretty rough period.
Right, and the biggest glimmer of hope has to be their sales growth. Think about this. They just saw their first monthly increase in comparable net sales, meaning sales at stores open for at least a year. Since February 2022, that happened back in August, and it's a huge deal because it shows they might be pulling out of that slump.
Absolutely. And to add to that, their online sales are also picking up. They had their best e-commerce quarter since the end of fiscal 2021. In today's retail world, you need a strong online presence. So this is a significant win for TLYS.
It's like they're finally figuring out how to connect with their audience, both online and in person. In fact, their in-store foot traffic increased for the second quarter in a row. Now, in-store sales are still down overall, but more people walking through the doors means their marketing efforts, like their brand refresh and social media push, might actually be working.
And don't forget their new sponsorship deal with the LA Chargers, which is a savvy move. They're focusing on youth mental health through this partnership, which aligns perfectly with TLYS support of the TLYS Life Center. It's a way for them to resonate with Gen Z on a deeper level and position themselves as a brand that cares.
It's not all just surface level stuff, though. Behind the scenes, TLYS is making investments in their website search engine, revamping their mobile app, and even implementing a new price optimization tool. These might not be headline-grabbing moves, but they show a commitment to improving the customer experience and making smarter decisions about pricing.
It's about laying the foundation for long-term success. They're tackling the core elements of their business, which is crucial in a tough retail environment. Now, let's dive into the numbers, because at the end of the day, that's what really moves the needle for investors.
Time to crunch some numbers. Net sales were down 13.8% year over year. But there's an important caveat here. Last year had an extra week, a 53rd week, which shifted some sales into the second quarter, so it's not a straightforward comparison.
Exactly. You can't just look at the top-line number and panic. E-commerce sales, for example, only saw a slight decrease, which again points to the strength of their online channel.
Okay, so let's talk about comparable net sales, which, for those who aren't familiar with retail jargon, is basically a way to compare sales from this year to the same period last year. But only for stores that were open during both periods. It helps us see if a company is truly growing. Now, TLYS' comparable net sales declined by 3.4% for the quarter. Not great. But here's the thing. It's actually their best performance in quite a while, which suggests things might be turning around.
Progress, not perfection. Right. Investors want to see improvement, and TLYS is showing some, albeit slowly. Now let's move on to margins, which paint a more mixed picture.
On the one hand, their product margins, meaning the profit they make on each item they sell, stayed remarkably similar to last year. They managed this by balancing increased markdowns with improved initial markups. In other words, they're getting better prices on the goods they're buying, which helps offset the discounts they have to offer.
It's a delicate balancing act. And for now, they seem to be handling it well. However, their overall gross margin, which includes things like occupancy costs for their stores, took a hit. This is because they're spreading those fixed costs over lower sales, a common challenge for retailers in a downturn.
So while they're managing their product costs effectively, those overhead expenses are still a drag on their profitability. Now let's shift our focus to their outlook for the rest of the year, which is a mix of cautious optimism and some potential headwinds.
They had a rough start to Q4. Comparable sales were down 15.3% through December 3rd, but we need to factor in the Thanksgiving holiday shift. Adjusting for that, the decline looks a bit less dramatic at 9.6%.
So the timing of holidays can really skew these numbers, and it's important to take that into account. The good news is that TLYS expects their product margin to improve by about 200 basis points. That's 2 percentage points. In Q4, this is partly because they're avoiding the drastic store-wide Black Friday discounts they offered last year.
It seems like they're learning from their mistakes and being more strategic with their promotions, which is encouraging. Their outlook does include a net loss for the quarter, but it's clear they're prioritizing profitability over simply chasing sales growth at any cost.
It's a long-term strategy that could ultimately pay off, especially in a challenging economic climate. But let's be honest, there are some red flags here too.
They're planning to close at least 10 underperforming stores, which is never an easy decision, but it shows they're serious about cutting costs and focusing on the locations that are actually making money.
It's like trimming the fat, right? They're getting rid of the dead weight to streamline their operations and free up resources for more promising areas of the business.
Exactly, and they're not stopping there. They're also actively working to reduce expenses across the board,
Right.
renegotiating contracts, and finding ways to be more efficient with their spending.
Every penny counts in this environment, and they seem to be taking that to heart. They even mentioned a recent change in their chief marketing officer, which could signal a shift in their merchandise strategy, maybe an attempt to find products that resonate better with their target audience.
It's definitely a development worth watching. Bringing in fresh blood can inject new energy and ideas into a company. So it'll be interesting to see what direction the new CMO takes them in.
Now, let's dig a little deeper into their earnings call transcript and see if we can unearth any more insights. One thing that jumped out at me was their emphasis on e-commerce. They're really doubling down on their online presence, which makes sense given the strength of their online sales.
They talked about upgrading the quality of their website's search engine, which can make a huge difference in helping customers find what they're looking for. They also relaunched their mobile app with improved speed and functionality, recognizing that a seamless mobile experience is crucial these days.
It's all about making it easier and more enjoyable for customers to shop with them, whether it's on their website or through their app. And they're also getting smarter about pricing with that new price optimization tool we mentioned earlier.
Absolutely. That tool should help them make more data-driven decisions about pricing and promotions, ensuring they're not leaving money on the table, but also remaining competitive in a crowded market.
They also addressed the elephant in the room, that tough start to Q4. They acknowledged the decline in comparable sales, but pointed out that adjusting for the Thanksgiving timing shift makes things look a bit less dire.
Right. Holidays can really mess with retail numbers, so it's important to take those calendar quirks into account. And despite the challenges, they still expect to see product margin improvement in Q4, partly because they're being more strategic about discounts and avoiding those deep store-wide Black Friday promotions.
So instead of just slashing prices and hoping for the best, they're being more targeted and thoughtful about their promotional strategies. That suggests a more disciplined and data-driven approach, which is a good sign.
They also provided some interesting details about their inventory management. They made a deliberate decision to pull forward certain inventory receipts to make sure they had enough product on hand for Black Friday and the holiday rush.
So they're being proactive and thinking ahead, which is essential in retail, especially during the busiest shopping season of the year.
And they were quick to point out that this was a temporary timing adjustment and that their overall inventory levels are in a healthy position. They're not sitting on a mountain of unsold merchandise, which can be a major problem for retailers.
That's definitely reassuring to hear. Now let's talk about their new marketing partnership with the LA Chargers. This seems like a really smart move to connect with their Gen Z audience.
Absolutely. It's a great example of aligning their brand with something that resonates with their target demographic. And the focus on youth mental health is particularly powerful. It shows they're not just trying to sell clothes, but also trying to make a positive impact.
And it ties in nicely with their support of the TLYS Center, which further reinforces their commitment to this cause. It's a win-win situation. They get to connect with their audience on an emotional level, while also supporting a worthy cause. But I'm curious, what stood out to you the most in the transcript? Was there anything that really surprised you?
You know, one thing that impressed me was their overall tone and attitude. They were very upfront about the challenges they're facing, but they also seemed genuinely optimistic about the future. They emphasized that they're challenging every aspect of their business, looking for ways to improve and adapt.
They talked about asking tough questions, examining their processes, and being willing to experiment with new ideas. That kind of a relentless pursuit of improvement is what sets successful companies apart. Especially in a dynamic industry like retail. They're not resting on their laurels. They're actively trying to evolve and get better.
Exactly. It's not just about reacting to the current market conditions, but also about anticipating future trends and positioning themselves for long-term success.
So, based on everything we've discussed, it seems like TLYS is at a crossroads. They're facing some serious headwinds, but they're also taking proactive steps to turn things around.
It's still early days, and there's no guarantee of success. But they're showing signs of life. They're making strategic investments, streamlining operations, improving their digital presence, and focusing on profitability.
It's a classic turnaround story in the making. Now, Talk Tickers listeners, it's time for our favorite segment of the show. This is not financial advice, where we cook up a wild but plausible trade idea. Based on what we've learned,
I always look forward to this part. It's where we get to let our imaginations run wild.
So, considering everything we've discussed about TLYS, their focus on Gen Z, their digital investments, their emphasis on mental health, what's our crazy, but maybe not so crazy, trade idea?
Let's see. Given their commitment to youth mental health and their partnership with the LA Chargers, I'm thinking...
Wait, hold on. I have an even crazier idea. What if we bet on TLYS becoming a major player in the, wait for it, the metaverse?
Whoa, a metaverse play. That's definitely thinking outside the box.
Think about it. Gen Z loves the metaverse, and TLYS is already trying to tap into that youth culture with their LA Chargers sponsorship and focus on mental health. What if they create a virtual world where teens can hang out, shop for virtual clothes, attend virtual events, all with a positive mental health message woven throughout?
I see where you're going with this. It's definitely a long shot, but it does align with their current strategy. And we know they're already investing heavily in their digital presence. This could be the next logical step.
Exactly. Imagine the possibilities. They could partner with other brands, popular influencers, even therapists, to create a truly unique and impactful experience. It could completely transform their brand image and attract a whole new generation of customers.
I'm starting to see the potential here. It's a bold move, but high risk, high reward, right? If they pull it off, it could be massive.
Absolutely. But let's be realistic, Talk Tickers listeners. This is pure speculation, not financial advice. Building a successful metaverse experience is no easy feat. It requires serious investment, technical expertise, and a deep understanding of their target audience.
And even then, there's no guarantee of success. The metaverse is still in its early stages, and it's unclear which platforms and experiences will ultimately win out.
So, we're just spitballing here, having some fun with the possibilities. But hey, maybe TLYS will surprise us all and become the next big thing in the metaverse. Stranger things have happened.
Talk about a comeback story. That would definitely get Wall Street buzzing.
Okay, Talk Tickers listeners, that wraps up our deep dive into TLYS Q3 earnings call. We've covered a lot of ground today, from their financial performance and strategic initiatives to our wild metaverse trade idea.
Remember, this is just our analysis based on the information available. It's important to do your own research and make your own investment decisions.
And as always, this is not financial advice. We're just two earnings nerds who love to dissect these calls and explore the possibilities.
Until next time, keep those earnings transcripts coming, and we'll see you on the next deep dive.